Unit 5, Operations Management, Subtopic 5.6, Production Planning. Lesson Objectives. By the end of this lesson, you should be able to understand local and global supply chains and contrast JIC with JIT. Understand and construct stock control charts and calculate productivity rates. Understand and calculate capacity utilization, defect rates, and operating leverage. Understand and evaluate cost to buy, CTB, versus cost to make, CTM. The supply chain is the system of connected organizations, information, logistics, resources, and activities that a business needs to reach its customers. It includes several external stakeholders, the suppliers, distributors, and retailers. Supply chains can be short and local, which is more sustainable, or long and international, involving exports and imports, which is less sustainable. There are two methods of stock control. The first is just in case, JIC, a traditional method where stock levels of raw materials and of finished products are high in case of a sudden increase in demand. The second method is called just-in-time, a more modern method where raw materials are supplied only when necessary and where goods are produced only when there is an order, without stock of finished products. Differences between JIT and JIC. JIT brings in stock only when required to keep inventory at near zero levels. This improves working capital by freeing up cash for daily activities. It slashes storage costs and prevents waste from damaged or obsolete stock. By clearing warehouse space, it allows for flexible production while requiring a very close, synchronized relationship with suppliers. JIC holds buffer stock to protect against supply delays or sudden demand spikes. This method reduces cash flow pressure and lowers costs through bulk buying economies of scale. Because all stock is stored ready for use, there's no waiting time for customers and no risk of delivery issues. Additionally, suppliers rarely charge premium prices for these non-urgent orders. Stock control charts. Deciding on stock levels is a trade-off between holding costs and the risk of running out. To analyze this, managers use stock control charts, often called sawtooth diagrams, to track inventory levels and reorder points over time. Buffer stock. Buffer stock is the minimum safety inventory held to ensure production continues during emergencies or sudden demand. Levels depend on usage rates, lead times, supplier reliability, and available warehouse space. While JIT aims for near-zero stock to free up capital, JIC uses buffer stock to avoid delivery issues and gain bulk buying economies of scale. Lead time. Lead time is the delay between ordering and receiving stock. It determines when to reorder to prevent falling below buffer stock, the safety reserve used for emergencies. Levels depend on usage rates, space, and supplier reliability. JIT reduces costs and waste by holding zero stock, while JIC holds buffer stock to meet sudden demand and gain bulk discounts. Reorder level. The reorder level is the specific stock level at which a business must place a new order for supplies. It is determined by the buffer stock, the usage rate of materials, and the lead time. A longer lead time requires an earlier order and a higher reorder level. Reorder quantity. The reorder quantity is the actual amount a manager orders to replenish used stock. This volume depends on storage capacity, usage rates, and costs. Ordering more frequently results in a lower reorder quantity, while ordering less often requires a larger quantity to be purchased at once. The capacity utilization rate measures the existing output relative to the maximum. It can be calculated using the following equation: existing output over a given time period divided by maximum possible output over a given time period times 100 equals percent capacity. Or this may be written as actual output divided by productive capacity times 100. Let's take a look at a few examples. Suppose a firm produces 300 units a week, but has a maximum output of 500 units. To find the capacity utilization rate, first, divide current output, 300, by maximum capacity, 500. Then, multiply by 100 to get a percentage. Calculation: 300 divided by 500 times 100 equals 60%. Let's take a look at another example. Suppose a firm produces 400 units a week with a maximum potential of 500 units. To find the capacity utilization rate, first, divide existing output by maximum output. Then, multiply by 100. Calculation: 400 divided by 500 equals 80%. Capacity utilization rate. Capacity utilization rate is the maximum a firm can produce using its current staff and equipment. It defines the maximum orders a business can handle at any moment. While capacity can be raised through investment over time, it currently depends on the number, quality, and efficiency of production factors. Managers must balance these resources to meet demand. Quick insight from Mr. K. Remember that capacity is measured in different ways in different businesses. For example, in a restaurant, it might be the number of meals you can serve in a day. In a stadium, it might be the number of seats. In an airplane, it is measured by the number of passengers. Defect rate. A defect rate is the percentage of total output that fails to meet quality standards. It identifies items with faults, like scratches or stains, which cannot be sold and are usually discarded. Calculated as follows: defect rate equals defective units divided by total output times 100. A lower rate is better. Operations managers aim to reduce this rate as much as possible, ideally reaching 0. Labor productivity. Labor productivity measures worker efficiency by calculating output value per unit of time, like units per hour. It helps identify underperforming workers compared to the average. The formula is total output divided by total hours worked. This metric can track a single worker, a whole workforce, or even a country for international macroeconomic analysis. Capital productivity. Capital productivity measures the efficiency of a firm's capital, specifically working capital. Working capital equals current assets minus current liabilities. Its productivity is calculated as sales revenue divided by working capital. These rates require context, such as comparing with competitors or tracking trends over time, to properly evaluate business performance. Operating leverage measures how effectively a firm generates profit from its fixed costs. High operating leverage means fixed costs are high. However, once these are covered, each additional sale generates significantly more profit. Low leverage firms have lower fixed costs, with expenses varying directly with sales. This structure determines the sensitivity of profit to changes in sales volume. Operating leverage can be calculated using the following formula. Operating leverage equals quantity times price minus variable cost per unit divided by quantity times price minus variable cost per unit minus fixed costs. To decide whether to make or buy, compare two costs. Cost to make is calculated as variable cost times quantity plus fixed costs. This represents total in-house production. The cost to buy is price times quantity, the cost of outsourcing. If CTM is less than CTB, the business should produce the item itself. This comparison ensures the most cost-effective choice is made. Suppose an esports team needs 5 gaming PCs. Should they buy them pre-built or build them manually? First, calculate the cost to buy, CTB. Formula: price times quantity. If a high-end, pre-built PC costs $1,500, then 1,500 times 5 equals $7,500. This is the total cost of purchasing from a retailer. Next, we must calculate the cost to make to find the most economical choice. Now, calculate the cost to make, CTM. Formula: variable cost times quantity plus fixed costs. If individual components are $1,100 per PC and specialized tools cost $500, then 1,100 times 5 plus 500 equals $6,000. Comparing the two, CTB is $7,500 while CTM is $6,000. Because building them in-house saves $1,500, the team should choose to make the PCs instead of buying them. Assessment tip: if you have to calculate a ratio, such as capacity utilization rate or productivity rate, do not forget to include the percentage sign in your answer. Even if the calculation is correct, without the percent sign, you would not achieve the maximum mark. The supply chain connects organizations, logistics, and resources to reach customers. It involves key stakeholders, suppliers, distributors, and retailers. These networks range from short local chains, which are more sustainable, to long international routes involving exports and imports, which are generally less sustainable. There are two main stock control methods. Just in case, JIC, a traditional approach maintaining high stock levels of materials and products to prepare for sudden demand spikes. Just in time, JIT, a modern strategy where materials arrive only when needed and production is order-driven, resulting in zero finished stock. JIC and JIT both have advantages and disadvantages. For example, JIC may reduce costs by buying in bulk and getting discounts from suppliers, but JIT does not require storage space. Holding stock can be expensive. Several elements must be taken into consideration when deciding on stock control. Minimum stock level is also called buffer stock. Lead time is the time between ordering new stock of raw materials and receiving it. In order to know how efficient a facility is, production managers can calculate its capacity utilization rate. Capacity utilization rate equals actual output divided by maximum productive capacity times 100. measure the efficiency of production, managers can also calculate the productivity rate. Productivity rate equals total output divided by total input times 100. Defect rate is the percentage of output units that fail to meet quality standards. Defect rate equals number of defective units divided by total output times 100. Labor productivity measures the efficiency of a worker. Labor productivity equals total output divided by total hours worked. Capital productivity measures the efficiency of the company's capital, especially its working capital. Working capital productivity equals sales revenue divided by current assets minus current liabilities. Operating leverage is the ratio of fixed costs to variable costs to calculate how well a company uses its fixed costs to generate income. Operating leverage equals quantity times price variable cost per unit divided by quantity times price minus variable cost per unit minus fixed costs. One business decision is whether to buy or to make. It may sometimes be cheaper for a business to buy a product made elsewhere, and even to import it rather than manufacture it. CTB, cost to buy, is calculated by multiplying price by quantity. CTM, cost to make, is calculated by multiplying variable costs by quantity and adding fixed costs. This brings us to the end of the lesson. Thanks for watching.